Hey, everybody. Happy Friday. It's Phil Hodgen here, and welcome to the Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month, noon Pacific time. Listen in online because that's what you're doing right now because it's live. Or you can watch the show later on YouTube. We post it after we get it back, and it'll be there for your viewing pleasure. There is no quiz at the end of the show. This month's topic is attribution rules for Form 5471. We are in episode 2 of the Form 5471 series, which is 11 hours of glorious Form 5471 topics that we're doing for CalCPA this year. And we're still in the first part, which is who is the filer? And today we're going to be examining the hard part of the hard part, which is share ownership. And that, by definition, means we're going to be looking at fun stuff like the attribution rules. So let's start with this. You can see here's our session outline, what's coming up. And we've got 2 more episodes of Who is the Filer. The next time will be the 9 categories of Form 5471 filers. And then in July, filing exceptions and reduced filing requirements. So yeah, I know I got to do the work. Isn't there some way out of it? And if there's no way out of it, can I do less work? That's topic 4. Anyway, let's get launched. Just a little slide here with the cutoff. So if you come back later, you know what I was referring to, which forms and where I was up to date as of today, May 26, 2023, in terms of law. And the objective here is, again, remember, we're talking about who is the filer. And we want to know, do we have a filing requirement for this person, yes or no? And if so, what are we eventually going to have to report on the tax return? And there are a lot of elements that you've got to look at for who is a filer of Form 5471. But the hard part is, and it's pervasive throughout the whole system, is that you have to have stock ownership in a foreign corporation. And so this magic word own is the kind of question that we're going to be addressing today. So here we are, table of contents for you. And we're going to be working our way through the 5 categories, the attribution rules for the 5 categories. And they're all slightly different because why wouldn't they be slightly different? It would not make sense to make a single set of attribution rules applicable generally, would it? He said with the sarcasm tags. So we start overview of today. The hard part of the hard part. Here's what you need just in plain English, not translated from code language, to have a Form 5471 filing requirement. You need, item 1, a United States person, that's a defined term, who is a shareholder and who owns or owned enough shares. And enough is a defined term too. And the hard part of that is, do you own shares or did you own shares? Because category 3, for instance, if you dispose of enough shares of stock in a foreign corporation, that triggers a filing requirement. The enough thing is there's different thresholds of ownership below which or above which fun things happen. And so, we'll have to do counting sooner or later, but for now, we just in abstract want to know, do you own it? And then the other part is you have to own shares in a foreign corporation, and that requires us to know the definition of foreign and the definition of corporation. We ain't playing that game today. So we're really just looking at this one word, own, O-W-N. Simple, isn't it? Well, if that's the hard part of this whole equation, figuring out if you're a filer of Form 5471, the hard part of the hard part is these 2 things I've highlighted, indirect ownership and constructive ownership. Direct ownership means that your name is on the share certificate, and that's usually not problematic unless there is a nominee and somebody's lying to you, because then you're reporting the nominee as the direct owner when really, truly it's not. But let's leave that aside. So we're really talking about indirect ownership and constructive ownership is what we are going to be talking about today. And here's how I'm using these terms as I talk through the whole process today. You have constructive ownership in this example. It's so you are the child of your father, and your father owns shares of a corporation. Because of the attribution rules, you are a constructive owner of the shares of your father's corporate shares. You have Now we come to the question of the company that you own, parent sub relationship. And direct ownership is your name on the stock certificate. Indirect ownership, think of it as an economic interest in the underlying company or whatever kind of stack of entity that you have. It could be partnerships, it could be corporations or whatnot. But there's an underlying economic chain that entitles you to some kind of value. And the way I like to think of it is, if we dissolved all the entities and shot the money and the assets upstream, would you get some? And if you do, that's an indirect ownership. And constructive ownership, by contrast, is kind of like an air gap. So if you want to think about it, indirect ownership is wired, and a constructive ownership is an air gap or a Wi-Fi, if you want to go, way out there in analogy land. And think of it also, finally, this word attribution. Attribution is the verb. We're talking about adjectives: constructive, indirect, and direct. Now, having told you that I'm being precise here in my terminology, I will also tell you that the code is not precise at all, and you're going to find places where they use the word constructive when they mean indirect and vice versa. So you have to be kind of careful and, frankly, not too dogmatic about this thing, even though I'm pretending to be dogmatic here. And I made this little slide here, on slide 10, just to show you that in every category of filer, everywhere that triggers a requirement to file Form 5471, there is a word that requires ownership of stock. So acquire, dispose, or own, right? So, and then once you have that word, then there's a lot of conditions and own what, own how much of what, and that kind of thing. But these are the requirements. I'm just showing you this to prove that ownership is the core to the whole question. The whole question being, do I have to file this damn form or not? Okay, so now why is it a hard problem, and why is it the hard part of the hard part? And here's the answer. It's because we have three different sets of attribution rules, depending for the five categories, I mean. So as we go through, the problem is that these are very similar, but not quite identical. And you'll start to see some of the differences as we go through. So for instance, your normal brain says, ha, there's never any sibling attribution. And I say, ha, back to you. Category 2 and 3 have sibling attribution. So do not let your brain go to sleep as you're doing this process. And in fact, anything in tax, because there are always little weird wrinkles. So let's now launch. We're going to go category 2 and 3 because the same attribution rules apply there. Then we're going to do category 5, and then we're going to do categories 1 and 5, category 4 afterwards, because it's its own standalone thing. And then 1 and 5 go together, and we'll wrap up with that. Just a reminder, category 2 people are US citizens or residents. So the implication there is only a human being can be a category 2 filer, who are officers and directors, and that's not defined in the code, of a foreign corporation. And their job is to tell the IRS every time some US person acquires enough stock in a foreign corporation. So your job is to be a rat. Category 3 filers are the people who actually own the shares. And it's an acquisition or disposition, but there are also some situations where you're just standing around and something happens and that triggers a filing requirement. So non-resident alien who becomes a US person, that's one. Certain captive insurance companies, that acquires. And happy me, the third bullet down and the fifth bullet down both apply to the same thing. So redundancy is a good thing. And finally, there's just, if you are a shareholder and a reorganization happens with a foreign corporation, that's a category 3. But we're only going to be talking about ownership and acquisition and disposition. We're not going to be talking about reorgs and captive insurance companies and all that fun stuff. So you'll see as we go through, we have family attribution, so human to human, and we have entity attribution, and there will be entity attribution from the entity upward to the owner. So we call it upward attribution. And there is also a category of attribution where we pretend stock ownership is owned by somebody other than the real owner, which is downward attribution. And we'll talk about that primarily in category 5, because the Internal Revenue Code put a bullet through a code provision in 2017 that created a lot of kerfluffle that we'll talk about in category 5. So first, attribution to family members. So from one human being to another in a family. So here's the rule, and I'm trying to put the code section or the regs in for your later reference so you can go look and see where it is, or at least have a reference so you can pull up the code on the screen and read it in full, because you're going to have to do that a bunch in this situation. The important thing here is to look at attribution from brothers and sisters, and that's in the first bullet point. And attribution from non-residents is not permitted. Therefore, attribution from non-residents can happen. So we are going to see the implications of that as well. And that may create some messes when you're preparing a tax return and trying to decide whether someone has a 5471 filing requirement. So here's a little map. You in the middle are blue, and the Internal Revenue Code is going to pretend that you own the shares of a foreign corporation owned by all of these people around you. You know, left to right, that's the family tree. You know, sibling at the top, a spouse at the bottom. Max attribution. So, and also max attribution from resident aliens as well as non-resident aliens. And these are the three things that are interesting and different for categories 2s and 3s compared to 1, 4, and 5. Look how they, instead of saying grandparent and grandchild, they go ancestors and descendants. Now, in real life, I've never had great grandparents and great grandchildren and all of that. It's everything I've done in my life has been as far as the grandparent relationship, and that's it. And then the other one, which is important and weird, is the sibling attribution. And that one I think may catch you a lot more often than you'd expect. And it also means that you have to ask a bunch of questions, right? That you wouldn't normally ask. Hey, do you have any siblings? What are they doing? Did they form a corporation? Right? So all of these questions you're going to have to ask, which may be a little bit intrusive and your client may hate you, but you got to ask. Now, asset acquisition by attribution. Remember that category 2 and category 3 talk about acquisition of enough stock, and I'm not going to define enough this time. We'll talk about it another time, but it's an acquisition. You didn't own any shares and now you did. So here I've got a situation where you've got two people married, and we know that there is spousal attribution. The non-resident alien spins up a foreign corporation and owns 100% of the stock. That means the non-resident alien acquired 100% of the shares of this foreign corporation. Spousal attribution says that you, the U.S. person, have acquired 100% of the stock of the foreign corporation because of this by constructive ownership. You don't own an economic interest in this corporation, but the constructive ownership rules say you have acquired stock, and therefore you have a category 3 filing requirement. Side note here, when you are looking at these kind of questions, first, just determine, looking at the code and the regs, do I have a filing requirement or no? How many shares do I own, which is the part that we're looking at today. But this expands into I have a filing requirement. Next step is, if I have a filing requirement, are there any applicable exceptions? And that's going to be a couple sessions from now where we're going to talk about exceptions. But do not start your analysis and figure out, do I have a job on my desk or not, by looking for exceptions. Follow the sequence all the way through. First, look at the code and regs. Do I have a filing requirement? Then look for the exceptions. Sorry to be dogmatic about that, but it could lead you astray, and I've felt that personally. Here's an interesting one. The question of acquisition by marriage. So a non-resident alien owns stock in a foreign corporation, owned it for 20 years. Yeah. And you come along, meet this person and marry this person. Have you acquired stock by marriage? I mean, on the day before you were married, you owned zero stock in this corporation, directly, indirectly, or constructively, however you want to look at it. And in this case, it would be constructively. And the day after marriage or on the day of the marriage, you owned constructively 100% of the stock of the spouse. So, did you acquire stock? I don't know. Um, you know, I've this one's puzzled me for a long time, and when I get the chance, I default to just doing a Category 3 filing just for kicks, just to put a pacifier in the screaming baby's mouth, quite frankly. Um, but like I got an email last month, hat tip to Les Edelman in Belgrade. And he raised the same thing. What's the metaphysical meaning of the word acquired? And I don't have any good answer. All I'm just saying is here's something weird in the code. So, attribution. Now we know we have attribution amongst family members. Let's talk about reattribution. So, making a second hop. And the answer is for category 2 and 3, there is no reattribution. So, stock goes from the direct owner to somebody else who's a constructive owner. It does not go from that constructive owner to a new constructive owner of a constructively owned shares. So let's see how this works. Pretend that father and his brother form a corporation, each own 25%, and unrelated person owns the other 50%. And father has a child, the blue one. More or less, when you look at all these little pictures, if you see a blue person, that means a US taxpayer. And I need to put a little logo or something on these slides to let you know. So the question is, you're preparing a tax return for child, and you wonder, I wonder if there's a 5471 filing requirement, category 3. Well, father, non-resident alien, owns 25% of the stock directly. And we know the attribution rules in 6046 say, well, you're going to have sibling attribution. So father's brother, uncle to the kid, has 25%. So father is deemed to own 50% of the stock of foreign corporation, 25% directly, 25% constructively. How much does the kid own? Well, look at the top. The green arrow says 25% father to child. Well, we know that's true because from in all the attribution rules, there's always parent-child attribution. But we don't make the second hop for the uncle's shares, the 25% owned by uncle. So uncle's shares go to father, his brother, sibling, but we do not then reattribute from father to child. So this is the general idea. And thank goodness for this, that otherwise we would have trees that we'd have to follow till the end of the earth to figure out what the attribution rules say. Indirect ownership through entity. So now this is the upward attribution. So think of the classic parent-subsidiary relationship, and you've got a shareholder in parent, and you're wondering whether the shareholder owns stock in subsidiary, and owns is in air quotes for Internal Revenue Code purposes. So categories 2 and 3, here are the rules that we know for sure. Foreign corporations, foreign partnerships, it's just a proportional relationship kind of structure that the shareholder at the top is deemed to own whatever, pro rata share of the stock that's owned by the foreign corporation or the foreign partnership. So quickie example in beautiful colors. You can just see it's a pro rata relationship. The blue stick figure owns 40% of the parent company. The parent company owns 80% of the subsidiary. And that means 4 times 8 is 32. So the little blue stick figure is deemed to have acquired 32% of the foreign corporation, the subsidiary stock. That's plenty. And there will be a category 3 filing requirement. on the right-hand side, the same thing applies for foreign partnerships. Just simple math. So the foreign corporations and foreign partnerships are the only thing that are talked about explicitly in Section 6046. So what else do we have? Well, we've got U.S. entities, corporations, and partnerships. And for those, I mean, now I'm going to take inferences and explain my thinking. You may or may not agree, but this is the way I look at it and approach it. The attribution of ownership upwards through entities to a shareholder. I say that the upward attribution is not going to happen here because the Section 6046 explicitly calls out foreign corporations, which are a different beastie than domestic corporations. In addition, domestic entities are going to have their own Category 3 filing requirements, and so there would be nothing added to have the shareholder upstream of this domestic corporation or partnership have a Category 3 filing requirement. Maybe I'm right, maybe I'm wrong. Email me if I'm wrong. Email is on the last slide of the deck that you got too, by the way. Foreign non-grantor trusts. I'm not so strong on this, but I believe there's no attribution through these things, or I forget the reference, but foreign non-grantor trust is treated as a foreign individual who never sets foot in the United States, as a general principle in the code. And so I'm not going to be attributing through that through that entity to a beneficiary, either of the trust or the foreign estate. And this also relies on the concept of, whatever is not regulated, by definition, you're free to do whatever you want. So the question is this a blacklist or a whitelist? And I'm just saying that if you haven't explicitly made a provision for it, then you've decided that you don't want us to have attribution for that entity. Grantor trusts and disregarded entities. I'm a little bit weaker on these. And the way I approach these is I look at these and say, how does the Internal Revenue Code deal with these kind of entities generally? So grantor trusts, generally the Internal Revenue Code looks at the entity and says, no, the grantor, the owner, under the grantor trust rules, is treated as the direct owner of the assets. And in that case, I'm going to look straight through the entity and look at the assets of the grantor trust, which in this case would be foreign corporation shares, and say the grantor is the owner of those foreign corporation shares and report accordingly. So I would have a Category 3 filing requirement for a sufficiently large acquisition or disposition of shares. Disregarded entities, same thing. This case, Suzanne Pierre versus Commissioner, is kind of murky, in my opinion, but it seems to say that for gift tax purposes, the basic rule for disregarded entities, and the law says disregarded for all tax purposes. And the Suzanne Pierre versus Commissioner tax court case said, well, actually, not really. That's so. And they said it's disregarded for income tax purposes, but not for gift tax purposes. So I think it's appropriate here that you just look through the disregarded entity, because this is an income tax question we're looking at, and just treat the single member of a disregarded entity as being the direct owner of foreign corporation shares owned by that disregarded entity. But these are just my hunches. Please feel free to enlighten me. Category 4. You're going to see a difference in the way the Category 4 rules work for family stuff. And it's, well, let's just shut up, Phil, and let's just do it. So first off, we're going to say who's a Category 4 filer. And taking a big zoom out, they're looking for a single taxpayer who has, quotes, control, close quotes, of a foreign corporation at any time in the tax year. Let's not care about time, and let's not care about foreign corporation. We care about this word control, and we're going to figure out what that means, because it's a function of share ownership. And also, just a side note, Note that you're not looking for controlled foreign corporations. You're looking for corporations that are controlled by a US person. Now, indirectly, if you have a category 4 filer who owns more than 50% of the stock of a foreign corporation, how could this not be a controlled foreign corporation? But, there you are. So this is what we're looking for. One person who alone owns more than 50% of the stock. And there's the regs, and there's the magic word owns. And we've got a more than 50% by voter value question. That's what we're looking for. So again, ownership. The law for figuring out the attribution rules for category 4, it will be found in 6038E2. So remember, category 2 and 3 was in Internal Revenue Code section 6046. Now we're playing in a different playground, section 6038. And that's why anything that you think you can carry over in your brain from figuring out constructive ownership for categories 2 and 3, you have to start over for category 4. And section 6038 does one useful thing. It says, let's invoke just bog standard section 318A constructive ownership rules, which is, more often than not, the code uses these rules to figure out constructive ownership. But it also adds 2 modifications. One modification is for downward attribution. So it's saying you don't have downward attribution from a foreign person to a domestic partnership, estate, trust, or corporation. So in other words, the partnership does not pretend that it owns whatever its partners own in terms of corporate stock. And then the other one is an upward attribution. And there's a threshold in section 318 that says, we don't care if you own 50% or less of the stock of a corporation. We only care if you're more than 50%. And for our purposes here in attribution, for category 4, we're dropping that to 10%. So that's going to make it a little bit interesting. It's kind of the floor is much lower. So it'll catch a lot more people in terms of calculating ownership of stock. Family attribution. First, let's go attribution to someone. And you can see it's quite a bit different from categories 2 and 3. So we're still allowing attribution from a non-resident alien because first we invoke the generic rules of section 318A for constructive ownership. And then B, we look around for any overrides to those, and those are found in section 6038E2, and there is no override there for attribution from a non-resident. So therefore, attribution from a non-resident is allowed. But now we're in the more familiar territory of grandparents and grandchildren. We have the normal section 318 rule that doesn't attribute stock from your grandparent to you, but will attribute stock from your grandchild to you. And we're also in the familiar territory of there's no sibling attribution. This is kind of more normal in my head. And I'm used to this kind of thing, so I understand it and I like it. I approve. I disapprove of categories 2 and 3, like they care. One of the interesting things that happens when you have attribution to family members is you can have the same shares could potentially be attributed for ownership purposes constructively to multiple people. So here I have a simple family unit, mom and dad and kid. And dad owns 100 shares of foreign corporation. Well, we have spousal attribution, so mom is also deemed to own those 100 shares. And son, we have parent-child attribution, so son is also deemed to own 100 shares. So now we have 3 people who have, quotes, control, close quotes, of this foreign corporation, 1 through direct share ownership and 2 by constructive ownership. What do we do? Does this mean that we have to file 3 different Form 5471s? No, it does not. Thank God. So there's a provision, and this is in section 318, the regs here, and I've quoted it here, that if you have a situation where you can attribute stock ownership in multiple directions at once, you pick the person, you pick one person, and you pick the person who, at the end of the attribution, will have the largest stock ownership. So this means that as between the mother and the child, we're going to pick one of those and we're going to say, you get the attributed stock, you are the constructive shareholder. And the other one, we're going to leave out of the picture entirely. So here's my little diagram showing that. And you can see, I'm not going to go through lines 1 through 8 down at the bottom, but you can read them later and you can see my thinking on how you handle this, how you decide. Well, in this case, if we've got 100 shares owned by mom and 100 shares owned by child and 100 shares owned by father, we know that father is going to have a Form 5471 quotes control, close quotes, for direct ownership. And we're going to choose one of the two constructive owners. And arbitrarily, we're going to choose mom because she's probably more likely to be able to sign a tax return than child. And so we're just going to do it that way. And you can see down below, I've got the sites to the instructions and which one you do and who doesn't need to file. So here's an example of an exception to filing requirements. So how we do it. But what I want to impress on you is that you would think that if you have someone who owns more than 50% of the stock, there can be only one of those kind of people, when in fact there can be multiple people who own more than 50% of the stock because of the attribution rules. And you'll have to systematically work through the analysis and then work through the filing exceptions to decide whether these constructive owners must or must not file as a Category 4 filer. Again, no reattribution from one person to the next. We had the same idea for categories 2 and 3, but the exception there was in section 6046 regulations. Here, the exception is built into the Internal Revenue Code section 318. And so you can see why there is no reattribution of constructively owned stock. And I've given you that. So remember, and I give this example specifically because remember the attribution rules say granddad, there's no grandparents, they're off limits. But the relationship between grandfather and father is parent-child, right? And then from father to child, again, is parent-child. And so grandfather's shares will be constructively treated as owned by father, but father, who is a constructive owner of the stock, those shares are not going to be in turn passed downstream to the child, triggering a Form 5471 Category 4 requirement for the child. But dad might have one unless he can find an exception to the filing requirements. Category 4, attribution from entities to owners. So this is the upward attribution idea. For all of these entities, partnerships, estates, non-grantor trusts, and grantor trusts, the rules are pretty straightforward. Partnerships and estates, it's a proportional share of estate-owned stock. You are a 25% partner. Partnership owns stock in a foreign corporation, you're deemed to own 25% of those shares. Estate, dead person owned 100 shares of stock of a foreign corporation. You're one of 3 kids who will inherit everything. So you've got a 1/3 share, you've got 1/3 ownership in the foreign corporation. That's the idea. Non-grantor trust, the excitement is in the actuarial computed share, right? You have a pro rata share, but it's according to your actuarial value of your beneficial share of the trust. And grantor trust, as you would expect, grantor owns 100% of whatever the grantor trust owns. Upward attribution from corporations is different. And this is, I don't know how yet. I'm going to have to keep playing with it, but this is the best I can get so far at trying to break it down into understandable. How do you figure it out? This top row, the less than 10%. So the first column is how much stock do you own in parent? And the second two columns, the middle and the right, are parents' share ownership in subsidiary. And you can see that the results change depending on whether the parent owns up to 50% or more than 50%. So let's walk through it. The first row that says less than 10%. So if you own less than 10% of the stock of parent corporation, you don't have to worry about deemed indirect ownership of subsidiary stock at all. That's your floor below which the government just doesn't care about you. So you don't have to worry about it. The middle column says you own 10% or more. So if you own 10% or more, you're in the category of you own a pro rata share of the parent company shares of subsidiary stock. And in that case, it's just going to be the simple math kind of calculations that we did before. You know, your percentage interest in the partnership in the parent company times parent company's percentage ownership in subsidiary, and you're done. But it's when you have more than 50% ownership of the parent company stock that things start to toggle a bit depending on how much stock ownership does parent company have in subsidiary. So the middle column here says if the parent owns up to 50% of subsidiary stock, we use the same pro rata share kind of methodology for determining control of subsidiary. But as soon as you own more than 50% of the parent, and right-hand column, parent owns more than 50% of subsidiary, then you are automatically in control of the subsidiary, which makes sense, right? Because if you have voting control and you can make parent corporation do anything it wants, and then parent corporation has voting control over subsidiary and can make subsidiary do anything parent company wants, well, control is transitive, and we have deemed control directly between you and the subsidiary. And this in simple diagram is showing exactly the rules that I talked about before, where you are above this 50% threshold. So step one, you own more than 50% of parent, CFC1. CFC1 owns more than 50% of CFC2. Therefore, you control CFC2, and you are going to have a category 4 filing requirement for CFC2, the subsidiary, unless you can find an exception or some way to do less paperwork. But the basic rule is, yep, you've got control, therefore you have a filing requirement. And the control is not because you are a direct shareholder, it's because of the attribution rules, indirect ownership in this case. Attribution from owners to entities. So this is downward attribution. So whatever the shareholder owns, we're going to pass that ownership and pretend that the corporation owned by the shareholder owns the stock. So simple example. My law firm is an S corporation. I also happen to own 100 shares of Microsoft in a Schwab account. Therefore, my law firm is deemed to own 100 shares of Microsoft stock. That's downward attribution. Attribution downward to partnerships, so from partners, estates from heirs, and trusts from beneficiaries. There's no threshold minimum requirement. It's strictly a pro rata share kind of rule. And you can see the authority and the citations and all that fun stuff. Grantor trust, again, we just pretend the grantor is the 100% owner of whatever is inside this grantor trust. For corporations, The downward attribution is a little bit simpler than upward attribution. We don't have this 10% floor thing. What we have is a greater than or equal to 50% rule. So you own shares of Corporation A and Corporation B. If you own more, 50% or more, I hate that. Anyway, I will not digress. If you own 50% or more of Corporation A, then we're going to pretend that Corporation A owns all of the stock that you own in Corporation B. So this is my example of me with an S corporation running a law firm and me owning shares of Microsoft in a Schwab account. And in that kind of situation, Corporation A is the law firm, Corporation B is the Microsoft stock, and we would attribute my ownership of Microsoft stock to Corporation A. Conversely, there's no downward attribution if you own less than 50% of Corporation A. In that case, there would be no attribution of Corporation B stock to you. Corporation B stock from you to Corporation A. Confusing? I think so. I really wonder sometimes why there's so much gratuitous complexity in the code. I'm just saying. Category 4, there's no downward attribution from a foreign person. So this is useful when you're looking at downward attribution to make a U.S. corporation, partnership, trust estate be deemed to own shares of stock owned by a non-resident alien. So it cuts down on the number of situations in which you have accidental downward attribution. And you're going to see the difference between having this prohibition here, no downward attribution from a foreign person, where it makes your life simple for category 4, to this provision was eliminated for category 5 and created all sorts of fun in terms of accidental downward attribution, and U.S. corporations suddenly became U.S. shareholders of controlled foreign corporations that they had no idea that they were going to be in that position with the Form 5471 filing. So let's look at that. So, just keep in mind there's no downward attribution from a foreign person, and a shareholder can be, a foreign parent corporation. It could be a human being. And let's wrap up with categories 1 and 5. Categories 1 and 5 work from the same base and they use the same attribution rules. I'm going to just be talking through about category 5 because category 5 continues to be a problem for everybody forever. Category 1 is slowly going away as a problem, because this was the result of the transition tax at the end of 2017. And that's starting to fade out because, if people put themselves on the installment plan, they're starting to pay off their taxes and get done with it. So category 5 matters to us. Now I'm going to step back a bit and just show you what category 5 really means, the kind of thinking that you need to go through, and show you where we are. So when you have a category 5 filer, the question is, are you a United States shareholder in a controlled foreign corporation? If the answer is yes, you're a category 5 filer. If the answer is no to either of those, you're not a category 5 filer. Because how could you be a U.S. shareholder if it's not a corporation? How could you be a U.S. shareholder in a controlled foreign corporation if the corporation is domestic? So those are the twin things. So when you start your process, the way I start is first I look, is the corporation actually a foreign corporation? It's easy to figure out, but it's also an easy knockout punch if you can use that to eliminate a 5471 problem. And we're looking at, are you a U.S. shareholder? And that has a function of, do you own shares? And then secondarily, do you own enough of those shares? And so that's where we are. And I gave you the rest of the flow chart down below that once you are a category 5 filer, you can see, all right, what kind of category 5 filer am I? Am I category 5A, 5B, 5C? And this is something that came into existence with, I think it was RevProc 2019-40. Anyway, now next month is going to be what category box do I check? And this is part of it. And once you've decided that you're in one of these subcategories, a 5A, 5B, 5C, then you go on to the next question and says, is there a filing exception that says, yeah, even though I'm a 5B, I don't have to file anything. Even though I'm a 5C, do I have to file anything? And then once you've gone through that whole process, then you either say, yes, a filing exception applies to me, in which case I'm home free, no Form 5471 requirement, or oopsie, too bad, I've got a 5471 filing requirement and a lot of work ahead of me. So that's where we are. I like to know where I am in the whole sequence, and we're right there. Are you a U.S. shareholder? And we're now going to talk about, do you own stock? And then secondarily, is it enough? But that's not really what we care about. It's the 10% threshold for what it's worth. First, family attribution. Do you own enough stock from by way of your family to be treated as a United States shareholder? So attribution from one family member to another family member. Important thing here is it looks a lot like category 4, doesn't it? Except there's one thing: no attribution from non-resident aliens to US persons. So that means if your dad is a US citizen, we're going to pretend that you own your dad's shares. If your kid is not a US citizen, we are not going to pretend that you own your kid's shares. So this is going to be a situation in which I see a lot of non-resident alien spouse, US citizen, taxpayer 5471 puzzlement person. And this is going to be the rule. This no attribution from non-resident aliens to US persons is what you're going to use to eliminate from your mind the nagging doubt: do I have a 5471 filing requirement or not? So that's the big difference. Non-resident aliens, nah. Again, no reattribution of constructively owned stock from one human to another, and then a second hop to yet another human being. Again, same thing. From granddad to father, father to child, it's the same rule out of Section 318. So we don't have a problem with the reattribution, and we know for sure that child does not have a Form 5471 Category 5 ownership problem, stock ownership problem. Dad, on the other hand, does. Attribution from non-residents. So I talked about this before, and I just want to look at it one more time because it is one of the more important ways that either you can get caught unawares or you can put your brain to sleep and say, thank God I don't have to do category 5. So category 5 says, we start at the top at that green box. We've got parent-child attribution, and there's the citation to the code. And then after we see the basic rule in Section 318, we say, are there any overrides? And the answer is, well, yes, there are. Section 958B1 is the code section that says, for Category 5 purposes, for determining whether you are a United States shareholder specifically, Section 958B1 says you do not attribute stock ownership from a non-resident alien to a U.S. person. Lovely pink box or whatever color it happens to resolve to. Result is the child does not have constructive ownership of father's stock of the foreign corporation. So in my little example here, Dad owns 95% of the stock of foreign corporation. Child owns 5%. For category 5, we say, okay, kid has 5% ownership directly, has 0% share ownership constructively from dad. Therefore, 5% is less than the 10% threshold for determining whether you are a U.S. shareholder or not. Therefore, child can never be a U.S. shareholder and can never have a category 5 filing requirement. But let's compare that to category 4, where we get the opposite result. Just to go back, because I like to compare different categories and different attribution rules against each other to highlight the anomalies. So again, we start from the same rule, parent-child attribution from section 318. Now we're looking around in section 6038 this time, because that's where category 4 lives, and there is no override for attribution from a non-resident alien to a U.S. person. So unlike 958, which is used for category 5, where there is an override, section 6038, which is used for category 4, does not have an override, and therefore child has constructive ownership of father's stock of foreign corporation for category 4 purposes, because now child has deemed 100% stock ownership, and 100% is more than 10%. Therefore, child is a United States shareholder, and furthermore, is a United States shareholder in a foreign corporation that happens to be what you need for category 4 control. More than 50% of ownership of a foreign corporation. So just little anomalies there. Keep that in mind. 4C, category attribution from entities to their owners. So upward. Upward we go. Here we have a more than 50% breakpoint for voting power. And remember how we talked about voting power as a transitive function in a parent subsidiary structure, where if you have control by voting power of parent and the parent has control by voting power of subsidiary, then we've got automatic deemed control of the subsidiary. Same thing happens in the context of category 5 for voting power, because what you're trying to do here is you're trying to decide for whether this person is a United States shareholder, and meaning how much ownership by voting power or by value does this person have in my example, the subsidiary. So that's why there are three different things you have to look at. You say, this slide is about partnerships and estates, and we'll move on to corporations next. But if a partnership or estate has up to 50% of the voting power of a corporation, a foreign corporation, then it's just a simple proportional percentage times percentage equals this is your voting power. Does it exceed or not the 10% threshold? If the partnership, as an example, owns more than 50% of the voting power of a foreign corporation stock, and you're a partner in the partnership, then we're going to take your partnership interest and multiply it by 100%, because the partnership has total control over the foreign corporation. What this means is that you can kind of take a little shortcut here, because remember, anytime you've got a voter value kind of question, you meet either of those thresholds, you're going to be fine. And so automatically, you know that as soon as the voting power owned by the partnership in this example exceeds 50%, it's always going to be a higher number than the value computation, because voting power of more than 50% is going to be your partnership interest times 100%, whereas the value computation will be your percentage interest in the partnership times the partnership's interest in the foreign corporation stock. All right. Upward from a domestic trust to beneficiaries. Why am I saying domestic? I'm saying this because the attribution, the indirect ownership rules for foreign entities is in section 95A, and this is a straight proportional thing, and section 958A2 specifically. And here I'm talking about how do you handle things when it's attribution through domestic entities, and that's section 958B. And so here are the rules. Again, we've got this thing about 50% or more, where as soon as the non-grantor trust, for instance, owns more than 50%, it's your actuarial interest in the trust times 100%, as compared to if the non-grantor trust owns less than 50% of the voting power of the foreign corporation. So in this case, again, if you're getting pushed into a voter value thing, do the voting power first, because that's more likely to come up with a higher percentage, unless you've got some weird multiple classes of stock and stuff like that, in which case, God bless you. But I mean, 99% of the problems that sit on my desk are single class of shares. So unlikely to be a mess for you. Upward attribution from a corporation to a shareholder. We have less than 10%, we don't care. As long as you exceed the 10% or more, we've got this up to 50% by vote, more than 50% by vote question that we've been talking about, and we do the attribution, and you can see the math computations there in the far right-hand column. Let's wrap up with downward attribution, because this is the puzzlement that came into our lives in 2017. And even, like late last week, I got an email from controller of a corporation. So, I think, oops, I think we've got a downward attribution problem, because they had, foreign parent company, US sub, couple foreign subs. What are our filing requirements? So here's a classic simplified situation. This was not a problem before the end of 2017. It is a problem now. So you have a foreign parent corporation. It could be a human, but let's just use a foreign parent corporation. And it has two subsidiaries, foreign subsidiary and domestic subsidiary. And note that we have this greater than or equal to 50% stock ownership in US subsidiary. Typically in the things that hit my desk, it's 100%, but it could be anything 50 and up. This situation, subsidiary A is a category 5 filer of Form 5471 because of downward attribution. So let's walk through and figure out why, and then we'll figure out what do you do about it. So here's what happened in 2017. That second bullet point is the rule that said, oh, we're not going to attribute stock ownership from a non-US person to a US person. So they nuked that. And so now that 958B4 is gone, the basic rule is at the bottom bullet point, which is straight out of section 318. So it's a 50% or more threshold by value. Then you're going to do the downward attribution. So I've got two pictures to show you, handy dandy. These are kind of noisy, but I don't know, seems to work. So this is the life before the Tax Cut and Jobs Act. Why there would be no downward attribution, why subsidiary A would not be a US shareholder, and why subsidiary B would not be classified as a controlled foreign corporation. And the answer is, if you look on the right-hand side in that pink box, the 958B4, now repealed, prohibited downward attribution from a foreign person to a US person. So we could not attribute parent corporation's ownership of subsidiary B stock to US person, subsidiary A. Easy peasy. So no Form 5471 filing requirement for subsidiary A. This is what life looks like now. So now that the little pink box in the right-hand corner has disappeared because Congress eliminated it, we are left with the default rule, which is Internal Revenue Code Section 318A3 capital C, which is quoted there on the right-hand side of the screen. And it's just the straight downward attribution. If you have 50% or more by value of the stock, if parent corporation owns more than 50% or more of the stock of subsidiary A, then we are going to attribute all of parent corporation's stock in subsidiary A to pretend that subsidiary B owns that stock. Well, all of a sudden, we've decided that subsidiary A owns constructively 100% of subsidiary B. What does that mean? First question is subsidiary A United States shareholder of subsidiary B? The answer is yes, because to be a United States shareholder, you have to own 10% or more of the stock of a foreign corporation. Does subsidiary A own more than 10% of the stock, or 10% or more of the stock of subsidiary B? Answer yes, by downward attribution. Next, we have to say, is subsidiary B a controlled foreign corporation? And for that, we say, is more than 50% of the stock of subsidiary B owned by United States shareholders? Answer is yes. Subsidiary A is a United States shareholder and owns 100% of the stock of subsidiary B. Therefore, subsidiary A United States shareholder, is deemed to own 100% of a controlled foreign corporation, subsidiary B, and therefore there's a filing requirement, category 5. And here you have the logic chain all the way through. And I won't read it to you because it's there for your later reference. And where does this leave us? Well, where this left us, if you remember the flow chart I showed you, it says, boom, we have a United States shareholder of a controlled foreign corporation, and you are a category 5 filer. Now what? We got to figure out, are you a category 5A, 5B, or 5C? And then after you've done that, you're going to have to look and see whether there's a filing exception. And categories 5B and 5C are head nods by the Internal Revenue Service to fact patterns where, as a practical matter, it is difficult or impossible for subsidiary A to acquire any meaningful data in order to fulfill its Form 5471 filing requirements, and therefore the information requirements are not eliminated, but they're reduced. So that's what happens. So, you know, what you know is you're in the pot and the pot's boiling, and you have to figure out, you know, how am I going to get out of this with the minimum amount of pain? And we're going to deal with that 2 sessions from now at the end of July when we talk about filing exceptions and reduced filing requirements. Downward attribution from other entities. Oh my God, I'm running over. Proportional rules, except for non-grantor trusts, which are the actuarial computation of your beneficial interest. And the conclusion is there are many rules, and I skipped most of them. And there are exceptions, and we'll deal with them later. My suggestion is move really slow, read the regulations, read the code every time, even if you remember it, and create an org chart and fully populate it. That's it for this time. See you next month when we're going to talk about the 9 categories of filers on June 30, 2023. See y'all.